Okay, let's unpack this. What if the secrets to becoming a truly successful investor weren't hidden in, complex financial models, but maybe more in the natural world?
Right.
Like, what if Charles Darwin held a key to unlocking better investment strategies? It sounds a bit wild, doesn't
That
it?
is initially, yeah.
So today, we're doing a deep dive into some really insightful sources that propose exactly that, applying these time-tested principles of biological evolution to investing.
Which can often feel pretty turbulent.
Definitely.
Huh.
Our goal here is to unpack these Darwinian ideas, the counterintuitive ones, that might really help you think differently about investing.
Yeah.
Maybe you're prepping for a meeting or trying to get up to speed on a field, or you're just curious. We want to give you that shortcut to being well-informed with insights that actually stick.
And what's fascinating, really, is how often investing, despite all the sophisticated talk, can feel like gambling. And the data backs this up, frankly. There was a 2021 S&P report looking at the U.S. market. It showed that somewhere between 75 and 90% of domestic funds actually underperformed the market.
Wow, 75 to 90%.
Over 5, 10, even 20 years. It's staggering. So most conventional methods, they just don't seem to work reliably long term.
So if the usual playbook fails that often, where do we look?
Exactly. And that's where our author comes in. They argue for a totally new mindset, sort of reimagining investing by applying these principles from evolutionary biology,
Okay.
but not as a strict do this prescription, more like a description of what successful strategies have looked like over time.
Okay, so here's where it gets really interesting, I think.
Mm-hmm.
Our sources start with this powerful, kind of counterintuitive idea. Don't be very lazy,
Very lazy.
which sounds odd, but it's not about doing nothing. It's about this deep, almost Darwinian caution about risk.
That's it.
The main thing is minimizing what they call type I errors, making a bad investment. They use this analogy of a deer at a watering hole.
Right. And think about that deer. It has to be incredibly sensitive to type I errors mistaking a rustle for a predator. Because if it makes that error, if it underestimates the threat,
It's game over.
it's game over. It dies. So the species survives by being overly cautious. It makes plenty of type 2 errors like running away when there's no predator, missing a drink.
Okay, so missing an opportunity is better than being eaten.
For survival, absolutely. And if we connect this to investing, it's Warren Buffett's rule number 1, never lose money.
And rule number 2, never forget rule number 1.
Exactly. It's all about preserving your capital, even if it means you miss out on some potential gains sometimes. This leads to this kind of paradox. A great investor is a great rejecter.
Rejector, meaning they say no a lot.
A lot. Because think about it. Even if you think you're, say, 80% accurate at picking good stocks from bad ones.
This sounds pretty good.
It does, but because there are so many more bad or mediocre opportunities out there than truly good ones, the math works out that maybe only 57% of the investments you actually select end up being genuinely good.
Huh. So most of the things you could invest in, you shouldn't.
Exactly. Most market opportunities just aren't worth the risk.
Okay, that's a strong case for being cautious.
Yeah.
But the immediate pushback, is, well, wouldn't you have missed Tesla or Amazon? Those huge growers.
That's the question everyone asks, right? And the answer from these sources is pretty blunt.
Huh?
Yep, we would have missed Tesla.
Really? They just own that.
They own it. Because the strategy isn't about catching every single winner. It's about avoiding the big losers, the ones that can wipe you out. There was this cool bumblebee experiment.
Okay.
Researchers used robotic crab spiders on flowers. After the bees encountered these predators, they started avoiding those types of flowers, even the ones without spiders.
So they got spooked.
Right. Their foraging efficiency went down. They missed out on nectar, type 2 errors. But their survival rate went up because they avoided the danger, the type I error.
Ah, okay. So for investors, it's about spotting those crab spiders or lions at the watering hole in the market.
Precisely. And the sources highlight several specific traps to reject. Like industries with serious governance issues, think about certain infrastructure or real estate sectors in India, for example, where regulations and cash dealings can create problems for shareholders.
Right.
Or avoiding corporate turnarounds. They almost never work, despite the hype. JCPenney is a classic example of a failed turnaround.
Very hard to predict.
Extremely. And detesting debt. Forget optimal leverage, survival is key. COVID showed us how debt-crushed companies like Hertz, J. Crew. A strong balance sheet is paramount.
Makes sense. What else?
Ignoring M&A junkies companies constantly acquiring others. Most M&A fails statistically. Think AOL, Time Warner.
Oh, yeah, disaster.
Huge disaster. Also, not trying to predict fast-changing industries. The 19th century railway boom and crash, the dot-com bubble, history is littered with these.
So much value lost.
Trillions. And finally, avoiding unaligned owners like state-owned enterprises or certain multinational subsidiaries where the parent company might extract value at your expense.
Because that's quite a list of things to avoid.
It is. It's about rejecting a long list of risks to preserve that capital. That's the laziness.
So if we're avoiding all that, what do we actually look for? The sources say high quality at a fair price, obviously, but defining high quality is tricky. And they use this surprising story from Siberia.
Yeah, the silver fox experiment is fascinating. Dmitry Belayev and Ludmila Trot, over like 60 years, they selected foxes based on only one trait. Tameness, just friendliness towards humans.
Okay.
And what happened was incredible. Over generations, selecting just for tameness caused a whole cascade of other changes. Their snouts got shorter, they started looking more dog-like, even their skull shape changed.
Wow, just from selecting for friendliness.
Yeah, it showed Darwin's idea about the correlation of growth. Selecting one trait can pull others along with it. So the question for investors is, what's the business equivalent of tameness? What single trait brings other good things with it?
And it's probably not the usual suspects, right? Like good management.
Exactly. Our sources argue against things like quality management teams because it's so subjective. How do you really measure that? Often it's just based on meetings where, managers talk so well.
Right. Could be misleading.
Or delusion or worse. And fast growth is another one. Sure, Apple worked out, but studies show most fast-growing companies actually flame out pretty quickly. High growth can hide a multitude of sins.
Okay, so if it's not management charisma or just raw growth, what is that key tameness factor for a business?
For the author's firm, Nalanda, the #1 filter is historical return on capital employed, ROCE.
Historical ROC. Why historical?
Because it focuses on what the company has actually done, not just what management promises it will do. It's tangible results.
Yeah.
ROCE is basically operating profit, EBIT, divided by the total capital the business uses.
So it cuts through some of the financial engineering.
Exactly. It avoids muddying the waters with tax rates or interest payments and just looks at how effectively the core business generates profit from the capital it has. Think Costco versus Tiffany. In 2019, Costco had lower profit margins, but its ROCE was much higher, 22% versus Tiffany's 16%. Why? Because Costco turns over its inventory incredibly fast, like every 31 days. Tiffany's, 521 days.
Huge difference in capital efficiency.
Massive. And sustaining high ROCE, consistently high, is incredibly hard. Competition should erode it. But some companies manage it. Nalanda's portfolio median ROCE is 42%.
42%. That's remarkable.
It is. And what it suggests is that companies that consistently achieve high ROCE are generally making good strategic decisions, allocating capital well, even if not every single decision is perfect. It simplifies things for the investor.
So high ROCE signals overall robustness.
Precisely. It's like biological robustness. Just like DNA has mechanisms to handle mutations, robust businesses can handle shocks and adapt. Take Havells, an Indian company with a 52% ROCE. They bought another company, Lloyd Electric, which had a totally different culture. Low price, growth at all costs.
Sounds like a clash waiting to happen.
It was. But Havells' leader used the company's inherent strength, its high ROCE DNA, if you will, to completely reposition Lloyd, invest in quality, change management. It was a successful integration because the core Havells business were so robust.
Okay, so robustness allows for calculated risks.
Exactly. Or look at WNS, the BPO company. Nalanda initially avoided it because too much revenue came from one client, low robustness.
Right, concentration risk.
Yeah. But then WNS lost that big client. The stock tanked. Market punished it heavily.
So Nalanda stayed away.
No, they bought aggressively because losing that client, ironically, made WNS less concentrated, more diversified, and therefore, in their view, a more robust business.
That's counterintuitive again. They bought after the bad news.
Because the bad news actually improved the company's long-term robustness profile. It was a calculated risk based on that core principle.
Okay, so you screen for historical ROCE, look for robustness, and then finally price.
Finally, price. And the Darwinian lesson here is patience. The market isn't stupid. Truly high-quality, robust businesses are rarely dirt cheap. You have to wait patiently for those moments when you can pay a fair price. Not cheap, not expensive, but fair. Valuation is always the absolute last step.
Which brings us back to this idea, don't be lazy, be very lazy. It's not just about picking stocks, but how you behave afterwards, isn't it? It makes you distinguish between, what did the sources call them? Proximate and ultimate causes.
Exactly. It's a really crucial distinction. Think about a dung beetle. It might have big horns, right? The proximate cause, the immediate reason, might be for fighting other beetles.
Okay.
But the ultimate cause, the deep evolutionary reason, mate selection. Winning fights gets you mates, passes on your genes.
Got it. Proximate is the how, ultimate is the why.
Sort of, yeah. And in investing, people get totally obsessed with proximate causes. Daily news, market swings, that quarter's earnings report.
The noise.
All noise. The ultimate causes are the fundamentals of the business, its competitive position, its ROCE, its robustness. Those change very slowly.
So ignore the noise. Easier said than done.
But there really is. Think about macroeconomic stuff. The Asian financial crisis in '97 caused sheer panic globally. But 6 months later, many solid companies like Walmart or Diageo had bounced back significantly. Or HDFC Bank in India, its incredible success wasn't about interest rate moves, it was about its long-term CEO, Aditya Puri.
So macro forecasts are mostly useless for this approach.
Our author basically says, economists can't predict the economy, so why should investors waste time on it? Same for market-related noise. Keynes called it a beauty contest, guessing what others will guess. Leads to FOMO, chasing bad companies.
Right. And thematic investing, like AVs or AI.
Can be dangerous. Nikola, the truck company, soared on the EV theme, turned out to be a fraud. Huge total addressable markets TAM doesn't guarantee success either. Apparel has a massive TAM, but look how many retailers struggle.
So focus on the company's fundamentals, the ultimate causes.
Yes. Thankfully, those ultimate causes are usually way too dull for the news cycle. The market overreacts to the proximate noise. Someone put $36,000 into a fund at the bottom in March 2009.
Okay, peak fear.
Peak fear, if they just held it, did nothing. By 2022, it was worth over $770,000. That's the power of ignoring the noise and focusing long-term.
And that long-term focus connects to another evolutionary idea you mentioned, punctuated equilibria. Sounds complicated.
It sounds it, but the idea is simple. Darwin thought evolution was slow and gradual, but the fossil record didn't always show that. Niles Eldredge and Stephen Jay Gould proposed that evolution actually happens in long periods of stability stasis, broken by short bursts of rapid change punctuation.
Yay, long calm periods, then sudden shifts.
Exactly, and this applies to business too. Mostly, great businesses stay great and mediocre ones stay mediocre. Stasis is the norm. Think about Fortune 500 companies. A surprising number stayed excellent for decades. Market leaders tend to stay leaders.
But change happens slower than we think.
Much slower. The key is not to confuse stock price volatility with actual business punctuation. Amazon's stock price went nuts in the dot-com bubble, but the business wasn't fundamentally changing overnight in the way the price suggested. That confusion leads people to buy lousy businesses when the price runs up.
Okay, so where are the real punctuations for investors?
The real punctuations are those rare market panics. The GFC in '08, the Euro crisis, COVID in 2020. Those are the moments when the prices of even high-quality, robust businesses can get temporarily knocked down.
So that's when the very lazy investor becomes active.
Exactly. And the Landis policy is basically ignore bad businesses always. But when a market panic hits those high-quality companies they already like, that's the buying opportunity. They bought WNS aggressively in March 2020 for $46 when it had been $74 just weeks before. Seize the punctuation for good companies.
So putting it all together, this deep dive really suggests success isn't about being smarter necessarily, but something else.
It's about patience, radical patience, fueled by understanding compounding. Our sources use this amazing rabbit story. Yeah, Darwin himself, apparently not great at math, understood compounding, but this story. In 1859, a guy named Thomas Austin released just 24 rabbits in Australia.
Okay, seems harmless enough.
You'd think growth was slow at first, but rabbits, they compound. By 1925, there were billions of them, an ecological catastrophe.
From just 24.
It shows how even small growth rates, given enough time, lead to truly exponential results. And the author says, what you need to be a successful investor isn't really intellect that's common, it's patience. That's rare.
And that patience translates into not selling, being very lazy about selling.
Exactly. The core of being very lazy is resisting the urge to sell great businesses. The sources give 5 main reasons.
Okay, what are they?
1, the evidence shows owning great businesses long-term works. A huge study found most stocks underperform, but overall wealth creation is massive and highly concentrated in a few winners held for a long time.
So winners pay for losers.
Which is reason two. How else do you pay for your mistakes? Nalanda had one huge winner, Page Industries, that paid for the losses on 7 other investments, 5.2 times over, just through compounding. You need those big long-term winners.
Makes sense.
3, you only get the benefit of compounding if you stay invested. Buy aggressively in downturns, sure, but don't sell winners just because the price went up, unless the actual business is fundamentally broken.
What about common reasons to sell, like sell high to buy low?
That's reason 4, those critiques are flawed. Sell high, buy low is basically market timing, which is futile. And the idea that my incremental return will be low from now on, that often leads to selling way too early and missing huge future gains. Great businesses keep surprising you.
Okay, and the last one.
Reason 5 is the homeownership analogy. People don't constantly trade their houses trying to time the market. You buy a good house in a good neighborhood and live in it. Treat shares in great businesses the same way.
Hold on for the long term.
Right. Which leads to this final thought, kind of a riddle they call the Yaksha Prashna of investing. Everyone sees immeasurable wealth being created by people who never sell, but they think and act as if it is selling that creates wealth.
Huh. That really makes you think.
Yeah.
So wrapping this up, what does this deep dive really mean for how you, the listener, might approach investing? It feels like a pretty dramatic shift from focusing on predictions and timing.
It absolutely is. It shifts the focus to these long-term evolutionary principles. So to recap, first, minimize those big catastrophic risks, type I errors. Learn to be okay with missing some opportunities, the type 2 errors.
Be a great rejector.
Be a great rejector. Second, identify high-quality businesses using objective history, like ROCE, not just gut feelings or trends. Look for robustness.
Like the Siberian foxes.
Exactly. Third, embrace radical patience. Ignore the daily noise, the proximate causes, and use those rare market panics, the punctuations, as buying opportunities for great companies.
Okay.
And finally, stay invested in your winners. Let compounding do its magic. Let them pay for your inevitable mistakes.
It's a very different framework.
It is. And maybe a final thought to leave you with. Scientists, they're usually full of doubt, always admitting how little they know.
Right. Humility is key in science.
But investors often seem incredibly confident after maybe one meeting with management. This deep dive suggests that real success in investing, like in science, might come less from thinking you know a lot and more from understanding what you don't know. So the question for you is, what assumptions about investing might you need to challenge to really embrace this kind of Darwinian mindset?
A lot to think about, definitely. Thank you for joining us on this deep dive into reimagining investing. Until next time, keep learning, keep questioning, and keep evolving your thinking.